Welcome back and happy Mardi Gras. So today we're doing a video on Occidental Petroleum Company. Now there's a few reasons I wanted to do this video. First one is obvious. It's the Warren Buffett disclosure that he actually has a 28% stake in the company. I can pull up that article. So look at it here. Occidental Petroleum surges after Warren Buffett discloses boosting stake to 28%. I love these clickbait titles because look at this. Surges, and what does it say? Rallied 1.8%. That's what they call surging. Okay, anyway, but even disregarding that surge of 2%, I think the fact that Warren Buffett owns 28% is a great sign if you're a shareholder or if you are potentially thinking about buying shares yourself. You know, what better thing to do than to follow Warren Buffett into an investment, especially if you can get it lower, right? Okay, so what we're going to do actually is we're going to go through all their financials, kind of piece together why Warren Buffett might have bought it. And then what I also want to do is kind of talk in general about the commodities business and why, you know, oil stocks and other commodity stocks are different this time around. So let's get started. First thing we're going to look at, and this is every quarterly report going back to 2007. I wanted to get it before the '08 crash. That's why I went back so far. But anyway, this is total revenue. So this is every quarter what the revenue is, and what we like to see here is climbing. And look at this. I mean, it's definitely climbing. The next thing we like to look at is I'm going to look at gross margin, because especially if you're comparing it to other oil and gas companies, you want to see what their gross margin is compared to, let's say, Chevron, Exxon, those guys. And you can see they're hovering around, you know, mid 40s, maybe even 50%. But like I said, that doesn't tell you as much on its own. What you want to look at is it compared to competitors, okay? Well, anyway, now what we're going to do is go to pre-tax income, and y'all know I like to use this as a quick rule of thumb to estimate fair value. So what I'll do is kind of look at the pre-tax income and say, all right, this is what they're making every quarter. Man, they had some rough quarters, huh? Look at this, minus 8 billion, minus 6 billions almost. But anyway, what I like to do is look at this and say, okay, what's a reasonable expectation for income for the next, 3-5 years? And I'd say probably $2 billion a quarter. So if I just say $2 billion a quarter times 4, that gets me about $8 billion a year. And I multiply that by 10 and I ratio it to the market cap. So what I do, you see here, the market cap's 55 billion. So you divide by 55, multiply by the current share price, which was 763 last night. And what you can see is that, the rough calculation shows fair value around $90 a share. All right. Like I said, that is a very crude way of calculating value, but it's a good first check if you're going to move on to a deeper dive in the company. So this is definitely a good sign because, it's showing almost 50% upside from the current price, okay? But that's it for the income statement. I want to show you some stuff with the balance sheet real quick. So what I really like about the balance sheet is that you can kind of get a story of the company, like about its history. And the first thing you're going to notice is this big jump up here. And that was actually whenever they bought Anadarko. That was with the help of Warren Buffett. He helped finance that deal and got some preferred shares out of it. That's that. And then what's a little concerning though is that since then it's been dropping, right? So that would trigger red flags, right? Because if you see assets dropping, you're like, hold up, what's going on? Are we just dropping inventory? Are we losing cash? That'd be, worst case scenario. What's happening? Okay, so what I'll do is kind of drill down further into that. I'll check, hey, is it the current assets that are dropping? And you're like, okay, it's not really the current assets, so that's good. It's not your inventory, it's not your cash. So then you want to go to, okay, is it PPE? So if I look at your property, plant, and equipment, you can see that's actually what's going down, okay? And what you want to make sure of here is that this is just depreciation, that it's not actually the gross property, plant, and equipment going down, that they're not selling it. So what I'll do is I'll go to the gross PPE, and you can see that it's actually been flat since that acquisition. I mean, a little drop off, but really hovering right at this $120 billion, okay? And just to drive the point home further, if I go to accumulated depreciation, what you'll see is this will be growing. And yeah, it is. Look at this depreciation recently. So the good news there about the depreciation is that if they're spending less CapEx than they are depreciating, which in this case, it seems like they made a big acquisition. Now they're depreciating a lot of those assets that they bought. So they're kind of getting a benefit here of a lot of depreciation, and they might not be having to do as much CapEx. So what you're going to see, what you should see, is a lot of free cash flow, okay, once we get to the cash flow statement. Real quick, I just want to show you their total liabilities. And you can see they went into this large amount of debt to buy Anadarko with Buffett, but then they've really been dropping that, okay? And dropping debt is great. Just real quick, I'm going to show you the total debt, okay? Yeah, look at that. Dropping total debt from, it was 50 million. No, not million. It was 50 billion. Now it's dropped, more than half, getting close to $20 billion total. All right, so that's really good. Now let's go to the cash flow statement. So the first thing we're going to look at with the cash flow statement is operating cash flow. And I think this is a great metric, but what you really are interested in is free cash flow. And free cash flow is operating cash flow minus your capital expenditures. So real quick, if I look at capital expenditures, where is it? Capital expenditures, you can see that, they're actually lower compared to the last time in the cycle, okay? And then I'm going to show you a ratio here between capital expenditures and your operating cash flow. So this is all your CapEx divided by all your operating cash flow. And we're at like an all-time low as far as that's concerned. I mean, look at this. You were above 50% most of the time, sometimes above 100, which is terrible. If you see businesses that you're having a CapEx over 100% of your operating cash flow, then you need to run away, right? But now we're in the, 25-ish, which is really good. So, and that's what I wanted to talk about oil companies and commodity companies in general, okay? What used to happen is that oil companies and other commodity companies, whenever they made a lot of money, they would invest in a ton of CapEx. They'd spend, huge percentage of their cash flow to grow. And because all their competitors had the same idea of growth, what they would do was they'd wind up oversupplying the market. Then the commodity price would crash. In this case, the oil prices would crash because of the oversupply. And now they'd be in a down cycle again, okay, or the trough. So what's happening now is that these companies are making a lot of money, but they're not investing in growth. There's a quote from the CEO of OXY, and I'll actually link that interview below where she says, look, we don't expect growth because we want to focus on share buybacks because we see huge value there. And that's a great sign, right? If the CEO is saying, hey, I'm going to use all my cash for share buybacks because I think that that's just the better use of money. That tells you that they're definitely shareholder focused and that they think the stock's at a discount, right? So 2 checks there. And that's what I want to show you too about the benefit of having such low CapEx as a function of your operating cash flow is that your financing cash flow now gets to really take advantage of it because now you have all this cash left over so you can use it in financing, which means you're either paying dividends or you're buying back shares or you're paying down debt. So this was the outlier where they took that big loan to buy Anadarko. So if I just throw that out for scaling purposes, look at this trend. I mean, really spending a lot of money on the financing cash flow side, which is good because really any way that you're spending money on financing is good for the shareholders, okay? Positive financing cash flow is not good. Okay, so now I want to look at free cash flow. All right, so here's our free cash flow per quarter. So what you want to do here, because this is how I'm going to do the valuation at the end, is kind of get an idea of what we think a reasonable free cash flow value would be. If you assume $2.5–3 billion of free cash flow per quarter, you're going to get a crazy overvaluation, which could be reality, right? I mean, if Oxy continues to make free cash flow above $2 billion a quarter, then their stock's going to be worth, over $100 a share easy, okay? But I want to be a little bit more conservative, so what I'm going to do is I'm going to say, let's say 1.5, okay? So I'm going to do $1.5 billion a quarter. So let me use that. I'm going to move to my DCF page. All right, so here's my DCF page. Like I've told you before, I'll send this to you for free. Just email me so I know, to send it to you, and I'll do it. So let's do the DCF for Oxy. Okay, so I said $1.5 billion per quarter. All right, so I multiply that by 4. That's $6 billion a year for free cash flow. I'm going to say growth at, let's say, 3%. And then if I discount at 15%, you can see my terminal value, like the net present value, I get $50 a share. Okay. I think that this was very conservative because of, I kind of went conservative in all 3 areas. I picked a conservative cash flow number. I picked a conservative discount rate. I would say like almost too conservative of a harsh discount rate, but that's how I include my margin of safety. and then I picked a very low growth rate. So let's just say that, we went a little bit more aggressive, and I'll show you how much that changes everything. So let's say $7 billion a year free cash flow instead of 6. Discount at the standard, 12%, and then growth at 4%. And what you can see is we actually get a terminal value or net present value of $87 a share, which was really close to that $88 I kind of estimated with the pre-tax income. I think it's probably closer to this number. It might even be higher than that. It probably is. If they're going to make $2 to $3 billion a quarter for, the foreseeable future, I mean, that price gets really crazy, right? So let's say that they make $2.5 billion a quarter, which is 10. If they make 10, now you're talking about the price. Oh, look, it's past the triple digits. You're talking about a stock price today of $125 a share. So it really depends on what happens with the earnings moving forward, or really with the free cash flow. And that's where I think it's really important to have some insight into the industry. Or you can look at it as, look, I know the conservative value isn't that low, so I think I'm pretty much guaranteed there, and then I have the potential for a big upside gain. But that's just one way of looking at it. I hope you learned something from this video. I hope you watch more, like and subscribe. I'll see you next time.